Hi traders, and welcome to another video. In this video we will talk about how price movements creates what we call structure. If you don't know how to read price action or market structure as a trader, you better start learning fast. It's the breathing pattern of the market. We saw in the previous video that the market moves in impulses and corrections, creating higher highs and higher lows in an uptrend and creating lower lows and lower highs in a downtrend. It's the ebb and flow of the market, and it's super important that you practice on identifying this. At first, the concepts of market structure and price action can be a little confusing. However, if you're a technical trader or investor, understanding what each term means and how they differ from one another is critical. In this video, we shed some light on these topics and break it down for you. Let's go. Now, what is price action? The concept of price action is vital to your technical analysis skill. Price action is how price behaves. Price action is the fluctuation of price over a period of time. It represents the changes in value. It acts as the basis for technical analysis, which is the study of past and present price behavior. For market technicians, price action is a foundation for all trading strategies and methodologies. To place continuous price action into a manageable context, all variations are charted. Price charts are a key part for technical analysis because they translate seemingly random ticks into a user-friendly visual format. When looking at a chart, a skilled trader can quickly see which of the three ways price action may develop: bullish, bearish, or neutral. The key thing to remember about price action is that it's a product of order flow. As buy and sell orders hit the market, price moves up, down, or sideways, in concert with evolving supply and demand. Market structure, then again, is a product of price action. It's the movements of price that creates patterns, no matter what type of chart we use. It are the lines on our line chart, the bars on our bar chart, or the candles on our candlestick chart. So it's crucial for a trader to know how to read it. As we saw in one of the previous videos, we, amongst many other traders, choose to use candlesticks most of the time. They just give us a little more data than a line chart, for example. We can read the color, the candle size, the shadow, or in other words the wicks, and they just tell us a lot more. A big group of candles can form patterns on the chart. These patterns are identifiable and they repeat themselves over and over again in the market. We will learn you how to find these patterns, what they mean, and how to trade them. A lot of times you will hear traders speak about market structure. This is one of the most important, if not the most important thing price action can tell us. Market structure also reveals key areas which we can include in our chart reading skills. As we already saw in the previous video, candlesticks are pretty simple, yet they tell us so much. We know the size of the bodies and the wicks define what type of candlesticks they are. If we want to use them to our best advantage, we need to learn when to give them more or less importance. The keyword is when. It's all about timing when it comes to candlesticks. So let's figure out where the best places are to look for hints from our little friends. To do that, we need to learn how to identify key zones on the chart. Because an engulfing candle doesn't mean anything when it's floating somewhere in the middle of nowhere. So let's start with explaining market structure first. So what is market structure? Market structure, also referred to as market state, is a representation of developed price action. Over any given period of time, price action ebbs and flows, moving up, moving down, sideways, and the result of these fluctuations defines the market structure. Market structure, by definition, is the simplest form of price movement in the market, but yet so misunderstood. The fact of the matter is that price has memory. Markets do not move in a completely random fashion day after day, but rather in similar ways that they have done in the past. Understanding how to read market structure will drastically improve your trading, and you will find it easier to know what price is likely to do next. It creates key support and resistance levels on the charts. The swing highs and the swing lows. They help us visualize and identify important zones. Market structure or price action is how many people take advantage of the markets without even using any indicators, also referred to as naked trading. We have already learned that price can only move in three directions: up, down and sideways. It trends and it consolidates. Understanding how to read the continuation of a trend or the failure of a trend all comes from being able to read the market structure. The majority of the time, the market goes in a sideways motion or a range, and then there are quick bursts in either direction, just as we saw in the impulse and contraction video. So what is market structure really? Whenever we are in an uptrend and price creates a new high, we can mark the previous high as structure. Then we can extend that zone to the right and consider that zone as a key zone that we need to watch in the future. Whenever we are in a downtrend and price prints a new significant low, we can mark that previous low as structure. We can do the same here as well, extend it to the right and know that this is a key zone that we need to watch in the future. Even when the market is going sideways for a while, the horizontal levels where price is bouncing back and forward in can be marked as structure. The structure zones above price are often called resistance, while the zones below price are often called support. They act as a ceiling and floor, but we'll just call them structure for now. When price breaks through them, that's what we call a break of structure. This tells us the market is ready to move. A small disclaimer: market structure and price trends can be different depending on the time frame we're looking at. We may see a certain trend on the daily chart, but on the intraday chart it may be completely opposite. For example, being on a daily chart, you may see the pair going up, a clear bull trend. However, zooming in on the intraday chart, a 1 hour chart for example, you may see a bearish trend. This is the difference between macrostructure and microstructure. The market moves in waves, small waves, big waves, and even bigger waves. Candles and waves are a little bit like Matryoshka dolls. Don't get tricked by the smaller movements inside the bigger movements. That's why we always do top-down analysis, meaning analyzing the market from the bigger time frame down to the smaller time frame. We need to know where we are relative to all time frames. Otherwise, we might be buying into a resistance level on the daily time frame or the weekly time frame without even knowing that this level existed, because we were only looking at the 30-minute or the 1 hour time frame, for example. Let's take a look at the schematic, which should help you better understand. The green arrows represent the 1 hour time frame moves. Price makes an impulse move up, then makes a retracement, creating a low, from where a new impulse move takes off, printing a higher high, which on its turns creates a higher low, and so on. As we can see, it stops creating a higher high at a certain point and reverses down. This trend reversal is happening on the 1 hour time frame. But on the bigger time frame, which is represented by the red line, it's only the beginning of a retracement. The red line could be the 4 hour time frame moves, for example. We can see that price is actually in an uptrend on the daily time frame. And because the trend is our friend, it also makes more sense for us to wait for buying opportunities on the smaller time frame again. But how can we see that the smaller time frame is turning bullish again, I hear you think? Well, that's what market structure can tell us. In this example, we can see how price is going down, creating new structure each time it's creating a new low. This can continue as long as the drivers of price stay unchanged and the market participants still have the same investment narrative. Okay, so we said before that we wanted to wait for price to turn bullish again, so we could start buying again. Why? Because the bigger time frame was bullish. The macro structure is the bigger time frame. It's very important because it identifies key levels in the market and gives us a better understanding of the direction, which could then be translated to microstructure and refined for finding entries. So when does the market turn bullish again? This happens when the smaller time frame trend bottoms out and breaks structure to the upside, creating a new higher high. We marked up the new following higher low, and this is the first safe place to get in for a buy. Please know that the market is not always 100% the same. Depending on the circumstances at the time, pullbacks can go deeper or less deep. When price created that first higher high, it violated bearish market structure. So we had a break of structure to the upside, waited for the retracement to happen, and we took our shot. As you can see on this chart, price was in a downtrend here, making lower lows and lower highs. When it created its last low here, price retraced to its previous structure and then fell down again, as expected, because we are still in a downtrend. When it then failed to create a new lower low again, it created some concerns for the bears. This tells us sellers are taking profit and leaving the market. What price does next is testing that zone again, and eventually breaking it by creating a higher high. This move is super important for traders, because it broke structure and the bulls will have the opportunity to get an entry at the next lower low. The lower low happens here, and the bulls take price higher again, making these highs significant structure in the market. This happens over and over again. Here, here, and here. Until price struggles to make new higher highs. And structure gets broken by a strong move to the downside, which we can see happening here. This is also called shift in momentum. Now that you should understand market structure, you can consider yourself one step closer to a profitable trader. And as always guys, thank you for your attention and we'll see you in the next video.